Picture this. You are given a magic dollar bill that, if you set aside, it will double in value each and every day for an entire month. How much would that lone dollar be worth by month's end? $5,000? $500,000? Would you be surprised to learn that in just 30 days of doubling in value daily, a single dollar bill would be worth a whopping $536 million? That is the power of compounding interest, one of the most important secrets to gaining financial freedom. And while you can't expect to turn $1 into over $500 million in a month, through the power of compound interest, you can let your money effortlessly accumulate over the course of your lifetime. Have you ever experienced the magic of compounding interest in your own life? Perhaps you've seen your savings grow with interest in a bank account, or maybe you've witnessed the value of your investments soar over time. Compounding interest follows a snowball effect, where your money grows bigger and bigger as it rolls down the hill. The more time you give it to roll, the larger it will grow. It's the process of earning money on your money, and it can make a significant difference in your wealth over the course of your life. Welcome back! In today's video, we'll discuss the remarkable concept of compounding interest and its potential to help you achieve financial prosperity relatively effortlessly. In this video, we will delve into the intricacies of compounding, explore its practical application, and discover how it can significantly impact your wealth creation journey. So, grab a pen and paper, and let's begin our exploration into the world of compounding.
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old.
Understanding compounding. Before we dive into the details, let's establish exactly what compounding truly means. Compound interest is a fundamental concept in finance that plays a crucial role in wealth accumulation and investment growth. It is a powerful force that can significantly impact your financial well-being over time. At its core, compound interest is the process of earning interest on both the initial principal amount and the accumulated interest from previous periods. Unlike simple interest, compound interest allows your hard-earned money to grow exponentially. As interest is reinvested and added to your principal, you'll watch and see your savings soar. All you need to consider are three key factors: your initial investment, the interest rate, and the time period. Whether it's years, months, or any other unit of time, compound interest works its magic to maximize your returns.
Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
The power of compounding. Now that we grasp the concept of compounding, let's explore its true potential by examining the critical factor of time. Time plays a crucial role in the effectiveness of compounding. The more time you give your money to grow, the more compounding can work its magic, leading to higher and higher profit levels. This is why it's absolutely essential to start investing as early as possible. Time allows you to weather market fluctuations and ride out short-term volatility. It provides a cushion against temporary setbacks and allows your investments to recover and continue growing. By staying invested for the long term, you can take advantage of the inherent resilience and growth potential of compounding interest. Before we get into two main ways to take advantage of compounding, let's take a look at a hypothetical scenario involving two friends, Alex and Bill. The Alex and Bill scenario.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
Alex begins investing $2,000 per year from the age of 25 to 35, investing for a total of 10 years. On the other hand, Bill starts investing $2,000 per year from the age of 35 to 65, investing for a total of 30 years. Both earn an average return of 8% on their investments. Surprisingly, despite Alex investing for only 10 years compared to Bill's 30, she ends up with more money due to the power of compounding. By the time they're both 65 years old, Alex has $372,000, while Bill has $279,000. While Bill was consistently investing for a long period of time overall, it is Alex who wins out by the time they hit retirement, due to jump-starting his compounding interest portfolio 10 years prior to Bill. If you want to be more like Alex, be sure to subscribe and give this video a like for more can't-miss personal finance tips.
And let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that $114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man.
Well, it's
okay.
You know,
Just tell
but
us.
I just want your audience to think for a second.
Okay.
The
Pause.
answer is about $400,000.
Oh.
Lump sum investments versus recurring. When it comes to investing with compounding interest, there are two primary approaches: lump sum investments and recurring investments. A lump sum investment involves depositing a large amount of money into an investment account all at once. This approach allows you to immediately take advantage of compounding interest on the full amount. It can be advantageous if you have a significant sum of money available or if you come into a windfall, as it gives your investment more time to grow and compound. On the other hand, recurring investments involve making regular contributions over time. This approach is beneficial if you don't have a large amount of money up front, but can consistently invest smaller amounts. With recurring investments, you can take advantage of dollar cost averaging, buying more shares when prices are lower and fewer shares when prices are higher. This approach allows you to mitigate the impact of market volatility and build your investment over time. Both lump sum and recurring investments have their merits, and the choice depends on your financial situation and goals. Lump sum investments offer immediate growth potential, while recurring investments provide flexibility and the opportunity to invest consistently. Ultimately, the key is to start investing early and stay committed to the power of compounding interest, regardless of the approach you choose. Let's take a closer look at the earning potential of lump sum investments versus recurring investments. Compounding with lump sum investments. Suppose you have $50,000 and you want to invest for 30 years, with an average annual return of 10%. The result is actually quite astonishing. Your $50,000 investment would grow to a whopping $863,000 over the course of 30 years. This exemplifies the power of compounding, where your money earns interest on interest, multiplying your wealth exponentially over time. In this scenario, even though you aren't regularly putting in additional investments into the portfolio, the initial investment of $50,000 is enough on its own to grow to nearly $1 million in just 3 decades. So, in essence, lump sum investments can be put in once and left alone to rack up thousands in compounding interest, without much afterthought or strategy to navigate through. Compounding with regular contributions. In addition to lump sum investments, compounding can also work its magic when you contribute regularly. Let's say you invest $500 per month for 30 years, with an average annual return of 8%. The outcome is also remarkable. Your monthly contributions would grow to over $1.1 million in 30 years. By adding your money to your investment and allowing it to earn interest on interest, you can multiply your wealth exponentially. Regular contributions have a twofold effect. Firstly, they increase the principal amount on which the interest is calculated, leading to larger returns. Secondly, these contributions are continuously reinvested, further accelerating the compounding effect. By consistently investing a fixed amount over an extended period, you tap into the power of compounding and harness the full potential of time. The example of investing $500 per month demonstrates the significant impact of recurring investments. Through regular contributions and compounding interest, your wealth grows substantially, and you can achieve remarkable financial milestones. Whether you opt for a lump sum investment or recurring contributions, understanding the power of compounding interest and the role of time is vital. By leveraging the potential of compound interest, you can pave the way for long-term financial success and build a substantial nest egg over time. Before we dive into a few different assets that can gain a ton of money using compounding interest, we'd love to know, do you have an investment portfolio that has performed well? If so, which method do you prefer, lump sum or recurring investments? We would love to hear your success stories, so be sure to comment below.
The biggest thing in making money is time, and I've had this long run, and so the compounding at the end turns into very big numbers. But you've got a tailwind in this country if you just own a cross-section of it. One big thing is keeping down expenses, and the other thing is not trying to pick one stock, but owning a large group of stocks and buying it over time, and then just sitting and paying no attention to people who say they know when to buy and sell stocks. Or
exploring assets for compounding. Now that we've discussed how compounding interest operates, let's take a look into a few different assets that can help us harness compounding's power. Stocks. One of the most popular assets is stocks, where compounding is driven by capital appreciation and dividends. Stocks have historically provided attractive long-term returns, and by reinvesting dividends, you can significantly boost your investment returns. When dividends are reinvested, they purchase more shares, which in turn generates additional dividends, creating a compounding effect that accelerates your wealth's accumulation. Mutual funds. Mutual funds offer another avenue for high-yield compounding interest. These funds pool money from multiple investors and are managed by professionals who make investment decisions on behalf of the investors. Mutual funds are typically invested in a nicely diversified portfolio of stocks, bonds, and other assets. The nice thing about mutual funds is you don't have to worry about picking individual stocks that may plummet over time. These funds are professionally managed and typically perform well over the course of your investment cycle. Through compounding, the returns generated by the underlying investments can grow exponentially over time, allowing you to benefit from the expertise of professional fund managers while you sit back and watch your net worth skyrocket. Real estate. Real estate investments also have massive compounding potential. Rental properties can provide a steady stream of rental income, which can be reinvested to acquire additional properties or improve existing ones. Over time, the rental income and property values can increase, leading to substantial wealth accumulation that is driven by the power of compounding interest. Additionally, real estate investments offer the possibility of leverage by using borrowed funds to amplify returns. Just take renowned real estate mogul Donald Bren, for example. His $16.2 billion net worth was built primarily through a massive portfolio of real estate holdings, such as office buildings, golf clubs, rentals, and more. He saw the potential in compounding coupled with reinvested rental income early on in his career, and his results speak for themselves. Bonds. Bonds, on the other hand, provide fixed income investments. Through compounding, the interest earned on bonds can be reinvested, generating further interest. This compounding effect allows bond investors to benefit from both the initial investment and the subsequent interest earnings, leading to the growth of the investment over time. To maximize returns in these assets, various strategies can be employed. Dollar cost averaging, for example, involves investing a fixed amount at regular intervals regardless of market conditions. And it can help smooth out your portfolio's performance during market volatility and take advantage of price fluctuations. Rebalancing your portfolio periodically is also a good idea, as it ensures that you maintain a suitable asset allocation and align your investment strategy with your financial goals. In conclusion, different assets offer unique opportunities for compounding. Stocks, mutual funds, real estate investments, and bonds each have their own characteristics and compounding mechanisms. By understanding these assets and implementing sound investment strategies, you can make the most of compounding and harness its power to build long-term wealth. Remember, the key is to start early, stay consistent, and allow time to work in your favor. What asset classes are you currently invested in? Which have performed the best for you, and which have flopped? Be sure to let us know in the comments. The power of compounding interest on personal finances. Now that we've explored how powerful compounding interest can be in the world of finance, let's review 3 main categories for which it can help your personal financial situation, setting you up for a stress-free financial future. Debt. Compounding interest can either work for you or against you when it comes to debt. If you have outstanding debts, such as credit card balances or personal loans, the compounding interest can significantly increase the total amount you owe over time. This is known as compound interest on debt, and it can quickly become a burden, making it harder for you to pay off your debts. However, by strategically taking control of your debt, you are able to beat compound interest at its own game. Here's how. Focus on tackling high-interest debts first and pay them off swiftly. By reducing your outstanding debt, you minimize the compounding effect of interest and save money in the long run. Let's illustrate this with an example. Imagine you graduate college with $50,000 in student loan at a 5% interest rate. If you stick to the minimum monthly payment, you'll end up paying much more over the loan's lifespan. The extended repayment period allows interest to compound against you, leading to less money in your pocket. However, if you consistently make higher monthly payments, not only will you pay off that debt faster, but you'll also spend less overall. This is because the lower principal balance means less interest accruing each month. Retirement accounts. Retirement accounts, such as a 401k and the individual retirement accounts, or IRAs, are designed to help individuals save for their golden years. Compounding interest plays a vital role in the long-term success of these accounts, allowing your retirement savings to grow exponentially over time. When you contribute to retirement accounts, your money is invested in various assets, such as stocks, bonds, or mutual funds. These investments generate returns, and over time, those returns earn additional returns through compounding interest earned on them. The longer you stay invested, and the higher the average annual return, the more pronounced the impact of compounding becomes. Let's say you start contributing to a retirement account at an early age and consistently invest a portion of your income. With compounding interest, even modest contributions can grow significantly over several decades, leading to massive funds by the time you're ready to retire. The earlier you start, the more time your investments have to compound, potentially resulting in a substantial nest egg by the time you retire. I would also like to retire one day, so be sure to give this video a like. Savings. Compounding interest also plays a critical role in growing your savings. Whether you're saving for a down payment on a house, an emergency fund, or other financial goals, harnessing the power of compounding can accelerate your progress. By placing your savings in interest-bearing accounts, such as high-yield savings accounts or certificates of deposits, CDs, you allow your money to grow over time. The interest earned on your initial deposit is added to the account balance, and subsequently, interest is earned on the increased balance. This compounding effect can lead to significant growth in your savings. To maximize the impact of compounding, it's essential to find accounts offering competitive interest rates and low fees. Regularly contributing to your savings and avoiding withdrawals can further enhance the compounding effect. Over time, compounding interest can help you achieve your savings goals more quickly and build a solid financial foundation. In all 3 categories, the key to harnessing the power of compounding interest is to start early and remain consistent. The longer your money has to compound, the more substantial the impact. By making smart financial choices, prioritizing debt repayment, leveraging retirement accounts, and growing your savings with compounding interest, you can set yourself on a path towards long-term financial stability and success. Remember, time is the crucial ingredient in the compounding equation, so the earlier you start, the better off you'll be in the future. It's also crucial to remember to subscribe to more content just like this, and get started on your path to financial freedom today. Considering luck and risk in investments. While compounding has the potential to generate significant wealth, it's crucial to acknowledge the role of luck and risk in investing. We all face setbacks along the way, but it's essential to learn from them and adapt our strategies. Diversification through research and a long-term perspective are vital in managing risk and increasing the probability of success. Another key aspect to keep in mind is to know that when you have accrued enough funds to sustain a happy, prosperous life, don't risk that safety net for greed. There are thousands of stories of those who have found success through investing only to become overly zealous, risking their earnings for ridiculous amounts of wealth. Sometimes these gambles pay off. However, most of the time, they end with a sad ending. Know yourself, your limits, and what it will take to keep you and your family alive and thriving, and make that your goal, rather than a ludicrous amounts of wealth.
It's a pretty simple concept, but over time, it accomplishes extraordinary things.
The power of compounding is undeniable when it comes to building wealth. By understanding the concept and giving it time to work its magic, you can unlock tremendous financial opportunities. Remember, the key is to start early, invest regularly, and explore different assets that align with your goals and risk tolerance. So, seize the power of compounding and embark on a journey towards a financially secure future. Investing can be an exciting and rewarding journey, but it's important to approach it with careful thought, research, and a long-term perspective. By staying informed, managing risk, and making informed decisions, you exponentially increase your chances of achieving your financial objectives. You now have a precise strategy for reaching your financial goals through compounding interest. So start today and watch your money work for you. Thank you for watching, and don't forget to leave your comments, questions, and personal finance stories below. Until next time.